Here's a little retirement planning opportunity that we've developed for the Critical Thought website. When one looks at the retirement industry, they come out and show us all these wonderful pictures of happy loving couples. Looks something like a Viagra advert. But what we should be saying is, how's it done? Where are the tax incentives and how do we achieve it? Many are encouraged to invest through unit trusts or share portfolios. But the tax implications are like this. You invest after tax income. Then the interest can be taxable up to 40%. Dividends tax will be imposed from 1 April 2012 at a flat rate of 10%. Then CGT can be imposed on the sale proceeds at up to 10%. And when you die, there's a CGT event, which can lead to another 10% tax, and an estate duty potential liability if your estate is above 3.5 million rand. Let's see if we can do better. If we simply invest through a retirement annuity scheme, investing in the same unit trusts, we find a completely different set of tax implications. First of all, there's a tax deduction on the investment. That can lead to a discount of up to 40%. Then, interest income to a retirement annuity is tax-free, and we no longer have retirement funds tax. There's going to be a complete exemption from dividend tax on dividends received by pension funds, retirement annuity funds, and provident funds. There's also no CGT on these funds. And when you die, the value of your investments in retirement annuity funds, pension funds, and provident funds will fall outside of your estate for both CGT and estate duty purposes. Those are enormous differences, but we have to say, well, there is a sting in the tail that there might one day be tax on withdrawal from the fund, but this can also be managed. When one looks at when one retires, we see that because one's no longer receiving a salary, you will be at the lower end of the tax tables, and this means that you'll be taxed at a far lower rate. There is also potentially a lower tax rate applied on lump sums, where they have put the bottom rung up to 315,000 Rand lump sum once in a lifetime withdrawal tax-free, and then a sliding scale. And that's certainly never going to be more than the original tax exemption that you had obtained. Well, let's have some more. When we withdraw, there's a new dispensation with regard to medical expenditure, but that doesn't affect over 65 taxpayers. So if funds are withdrawn from a retirement annuity to pay medical expenses, zero taxable income results. And there's no donations tax. This is a completely acceptable form of tax planning. Let's demonstrate it with some numbers. If I'm planning to retire at 65 and I'm currently 50, and I invest 10,000 rands per month, 75% into equities, and therefore 25% into interest-bearing investments, and I increase my annual contributions with the inflation rate. We will say that the interest rate at present is the same as the inflation rates, and we're expecting that equities will grow at 3% above the inflation rate, and that dividend yield is currently 3% below the inflation rate. If the current inflation rate is 6% and my marginal tax rate is 40%, then we will achieve the following. Over the next 15 years, up to my retirement, I will save through a unit trust about 1.8 million Rand if my savings objectives are achieved. But because of the lower taxes caused by the exemptions granted to a retirement annuity fund, the lump sum within a retirement annuity fund will have increased to 3.1 million. That's a saving of 1.3 million Rand over the next 15 years. It's a phenomenal difference. If you'd like to try your own computations of this nature, please download this instructional video and the Excel spreadsheet from www.criticalthought.co.za.